£22 billion. That's the size of the write-down Stellantis has just been forced to absorb, tied directly to collapsing demand, severe factory overcapacity, and an electric vehicle strategy that has, by almost every measure, gone badly wrong. Buried inside that figure is one of Britain's most recognisable car brands, a name that sat on more driveways, in more company car parks, and outside more terraced houses than almost any other badge on UK roads for the better part of a century. Vauxhall didn't get into this position overnight, and it isn't the result of a single bad decision. It's the product of a corporate merger, an engineering compromise that's now haunting owners on the used market, and a piece of government regulation that collided head-on with a consumer market that simply wasn't ready to follow it. This is how each of those three forces combined to bring one of Britain's most familiar car brands to the edge, and what it actually means if you're currently driving one or thinking about buying one second-hand. The story starts with the creation of Stellantis itself. The conglomerate formed when PSA Group merged with Fiat Chrysler, bringing 14 separate car brands under one roof. Vauxhall came along as part of that consolidation, and the strategic logic applied to it from day one was the same logic applied across the entire group. Cut cost by sharing everything possible across brands, as fast as possible. In Vauxhall's case, that meant the effective end of anything that made the engineering underneath a Corsa or an Astra distinctly its own. Platforms, engines, electronics, even interior switchgear were standardised across the group. A new Vauxhall built from this point onward wasn't really a Vauxhall underneath the badge. It was a Peugeot or a Citroën wearing a different plastic shell, built on the same line with the same components, differentiated mainly by grille shape and trim naming. That decision made enormous sense on a spreadsheet in Paris. It made considerably less sense on a British forecourt. Vauxhall's entire commercial identity in the UK had always rested on being the sensible, accessible, slightly cheaper alternative. The brand people bought precisely because it wasn't trying to be anything more than dependable family transport at a fair price. Once the platform-sharing strategy took hold, that price advantage largely disappeared, because the car underneath was now identical in cost to build as its French and Italian siblings. Buyers noticed. A brand built on being the practical, honest choice was suddenly asking premium adjacent money for what was functionally a rebadge, and that mismatch between price and perceived value did lasting damage to consumer trust well before the financial figures caught up with it. While that identity erosion was playing out in showrooms, a separate and much more concrete problem was quietly building inside the engine bay of hundreds of thousands of cars already on British roads. To hit emissions targets during the final years before combustion engines were phased out of the new car lineup entirely, Stellantis rolled out its small-capacity 1.2-litre three-cylinder PureTech engine across an enormous share of the Vauxhall range, Corsa, Astra, Crossland and beyond. The design choice at the centre of the engine's efficiency gains was a wet timing belt. Rather than running dry outside the engine, the timing belt sits inside the crankcase itself, bathed continuously in hot engine oil. The theory was sound. Running the belt in oil reduces friction, which marginally improves fuel economy. The practice, particularly on cars used mostly for short urban journeys, stop-start school runs, brief commutes, the kind of driving pattern that's extremely common across British car ownership, turned out to be considerably less forgiving. Oil that never gets hot enough for long enough to burn off contamination breaks down chemically faster than it should. That degraded oil, in turn, accelerates the physical breakdown of the rubber belt material sitting inside it. The failure mode that follows is genuinely nasty. Microscopic fragments of disintegrating rubber flake off the belt and circulate through the oil system, where they clog the oil pickup strainer and the vacuum pump. Once that happens, oil flow to the rest of the engine is restricted at exactly the moment the engine needs it most, and the result is often sudden. complete engine failure, with no meaningful warning beforehand. Repair quotes for owners caught out by this typically land between £3,000 and £5,000, on cars that are frequently worth less than that on the open market once the failure has occurred. For a huge number of owners, the mechanically honest answer to "is it worth fixing?" is simply no, which is precisely why so many of these cars are being scrapped or broken for parts rather than repaired, quietly depressing supply and confidence in the used Vauxhall market at the same time. If the engineering side of this story was a slow-building mechanical crisis, the second half is a much faster, much more brutal commercial one, and it centres on regulation rather than metallurgy. Under the UK's zero-emission vehicle mandate, manufacturers are legally required to hit a rising minimum percentage of fully electric vehicles within their annual new car sales. Miss that target, and the penalty is severe: £15,000 per non-compliant combustion vehicle sold above the allowed threshold. For a manufacturer selling in the volumes Vauxhall does, that's not a rounding error fine. It's an existential threat to the entire sales operation if targets are missed by any meaningful margin. Stellantis' response was to push electric Corsas and Mockers into the UK market hard and fast, well ahead of genuine mainstream demand catching up. The problem is that the British buying public, for a long list of reasons that have very little to do with Vauxhall specifically, simply wasn't ready to absorb that volume of entry-level electric cars at the price points on offer. List prices remained high relative to combustion equivalents. Electricity costs at public chargers climbed rather than fell. The public charging network continued to expand more slowly than promised, and early depreciation on battery packs left buyers nervous about long-term value in a way that combustion cars, whatever their other faults, simply don't attract. Faced with a choice between paying enormous regulatory fines or moving stock at almost any cost, Stellantis chose the latter. Electric models were discounted aggressively, production was scaled back, and huge volumes were pushed through lease and fleet channels at margins close to zero, just to keep the compliance numbers where they needed to be. When even that wasn't enough to move the volume required, the backup plan ran out of road entirely. Thousands of unsold electric and hybrid vehicles ended up sitting in storage yards, while production uncertainty settled over the Ellesmere Port and Luton plants that build them. That is, in plain terms, where the £22 billion actually comes from. It isn't an abstract accounting adjustment dreamed up in a boardroom in Amsterdam. It's the combined weight of collapsed asset values, halted production lines, and an investor base that has stopped believing the current strategy gets Vauxhall back to profitability on its own terms. None of this stays contained inside Stellantis' balance sheet. It lands directly on the resale value of every Vauxhall currently sitting on a British driveway, and the effect has been faster and sharper than the brand's historically steady, predictable depreciation curve would ever have suggested. Electric Corsas and Mokka E models that carried £34,000 price tags brand new just 3 years ago are now struggling to clear 11 or 12,000 on the used market, a collapse in value that outpaces almost anything else in the current second-hand landscape. Dealers, for their part, have grown visibly more cautious about taking recent Vauxhall models in part exchange at all, caught between unpredictable resale values on the electric side and the lingering, entirely justified reputation of wet belt failures on the petrol side. That caution is rational, not unfair. A dealer taking in a used PureTech engined Corsa without full verifiable main dealer service history is taking on a genuine mechanical lottery ticket, and the wholesale trade has priced that risk in accordingly, which is part of why part exchange offers on these cars often land lower than owners expect, even before you factor in the brand's broader reputational damage. If you currently own a petrol 1.2-litre Vauxhall built from around 2018 onward, the belt issue is worth taking seriously rather than filing away as internet scare talk. Oil condition is the entire ballgame here, using exactly the manufacturer-specified oil grade, never stretching service intervals, and having the belt itself inspected or proactively replaced well within the recommended window rather than waiting for a warning sign that often doesn't come, is genuinely the difference between routine maintenance and a catastrophic bill. A preemptive belt replacement is not cheap, but it's a fraction of the cost of a destroyed engine, and unlike a dry belt failure, this one tends to arrive with essentially no warning. If you're shopping the used market rather than already owning one of these cars, the calculation is simpler still. A recent Stellantis-era Vauxhall, without complete verifiable main dealer service documentation and some form of warranty cover, is a considerably bigger gamble right now than the badge's old reputation for dependability would suggest. That reputation was earned under a different engineering regime, built by a different parent company, and it hasn't automatically carried over into the current generation of cars. Step back from the individual mechanical and financial details, and what's actually happened to Vauxhall is a fairly clean case study in what occurs when three separate pressures converge on a single brand at once. A cost-driven merger strategy that erased what made the badge distinct. An engineering shortcut adopted to hit a regulatory deadline that's since become a genuine reliability liability, and a second regulatory deadline, this time on electrification, that arrived faster than the consumer market was willing to follow. None of those three forces are unique to Vauxhall. Platform sharing is standard practice across most of the industry now. Small, turbocharged engines chasing emissions targets have caused reliability headaches well beyond Stellantis' own brands, and the tension between government-mandated electrification timelines and real-world consumer readiness is a live issue for every manufacturer selling in the UK right now, not just this one. What makes Vauxhall's version of this story unusually severe is simply the scale at which all three landed simultaneously on a brand whose entire commercial identity depended on being the safe, predictable, boringly reliable choice. The one attribute this convergence of pressures has done the most damage to. Whether Vauxhall recovers from this depends less on any single fix and more on which of these three pressures the parent company chooses to address first. Rebuilding some genuine engineering distinctiveness, resolving the wet belt reliability question definitively rather than quietly, or finding an electrification pace that the actual British car-buying public is willing to follow rather than one dictated purely by fine avoidance. Right now, the balance sheet suggests none of those three problems has been solved yet, only priced in.